Hello and welcome to Trading with Technical Indicators. My name is James Boyd. Welcome to this Monday as we talk about a little Black Swan event this morning that we had. I was out of the office this morning. I've been up since 4 though, and I have been watching what's been happening in the semiconductor space. But that's why I wasn't posting this morning, because I was out of the office. But we're back. So I'd like to welcome Mike, Greg, Randy, Lena, Scott, and many others. Welcome to all. Today, we want to kind of talk about the portfolio, at least the IRA, was really top-heavy in technology. I want to kind of talk about the after effects of that, and if any positions were stomped out. I'll give you a hint. There was 3 positions stomped out. We will talk about those and the effect it had on the overall portfolio, maybe some of the learning lessons from that, but also a very good reminder of just kind of risk management and why we try to practice what we do. Now, as we talk about this, remember that we're going to talk about trading with technical indicators. I'll give you a quick heads up. For a Black Swan event or news out of the middle of nowhere, there's no indicator that's going to tell you that news is going to come out like we had this morning. Now, as we get started, remember that the information provided here is for general informational purposes only. Options carry a high level of risk, not suitable for all investors. So we'll talk about stocks, but also we'll talk about options. One of you had a question on options, maybe the use of options with stock, etc. We'll talk about that. I got your questions written down, and we'll attack those as we go over examples. Also, short options can be assigned at any time up to the expiration, regardless of the in-the-money amount. We're talking about American options, not European. European can only be at expiration. Okay. When we also talk about paper money, we will be using the software application, investing involves risk, including loss of principal. And also remember that today, I want to talk about just real quick, kind of some of the differences we're seeing in the indexes. It's kind of funny. It's not all the same. And then we'll talk about just sectors. Are investors fleeing a certain area and running to the other one? We'll talk about that. And we'll also look at stock positions / option positions we have and earnings. So the last 2 bullet points there, we'll talk about stocks that maybe could be potential examples, and then earnings, which you know that there's many stocks coming up with earnings. You got Starbucks today, you got Tesla tomorrow, you got Apple, and many other stocks coming up. So we'll take a look at those and those setups there. Now, just real quick, what I want to do is I'm going to bring up just real quick the Market Watch tab, and we're going to look at indexes just briefly, okay, before we dive in. Dow Jones is sitting here plus 47. Now, Dow futures were down 400, okay? The index, okay, from 9:30 to 4 p.m. Eastern, you're going to see that it's positive. So larger caps not really showing any effect. Russell, down 25 points. It's down 1%, noted. You're going to see the S&P down 117. Now, remember, it has a heavier weighting to the technology space, okay? And that's down 1.93, the index is, but the damage, okay, is really the NASDAQ down 727 points, 3.34. Now, if we were to kind of really take the culprit, right, the semiconductor index, I'm talking about the index, okay? Company out of China called DeepSeek, similar to ChatGPT, and it made a huge ripple in terms of what their product potentially or service could do compared to, let's say, U.S. products and companies. Now, I'm going to bring up the semiconductors for just a sec, and this is not something you're always going to see, a hard gap. Now, the problem was the news came out overnight, okay, and it gapped the index down. Now, why is that? Why do we want to know that? Well, we want to know that because what that really means is for if we had stock positions or options positions, we set stops, there's risk of maybe the losses being bigger than expected, meaning it didn't just gap down and then slowly bleed down throughout the day or quickly. This is a solid gap down. Now, if we said semiconductors, we would have to bring up NVIDIA. And if you take a look at NVIDIA here, what you're going to notice is closing price on Friday, 142, and you're going to see the opening price, mama mia, 125. So it opened up $17 down, which we're going to come to, okay? And you're going to see it went even lower than that. The lowest price it went to is really 117. So clearly this is, I want to talk about this because we had that position. We still have a position. We'll talk about that. But I want to talk about the position that was exited here today. Now, if we take, and there's three of them, okay? Now, so when we talk about markets, when I take a look at Dow Jones just quickly, didn't really move, okay? Still there. Green on the moving averages. SPX didn't really change anything. Kind of back in the middle of the channel, okay? Top heavy weighting to tech. We can see that, okay? NASDAQ, what does that look like? You look at the NASDAQ, that one's a little uglier. Kind of was right at the spot of could it extend, and it faded thanks to semiconductors and that China. We'll see more about that. But if you look at the Russell, not much of a difference there. So we kind of have an isolated event hurting NASDAQ. And in that space, we're talking about semiconductors. Semiconductors, I have not seen a move that large of a gap down a long time, if ever. Okay. I mean, very, very low probability of that happening. Now, sectors wise, okay. Now, if we take a look at this, I like to kind of think of this on one side, you have higher beta, right? More volatile stocks. We know technology, discretionaries, and so on, more volatile stocks, more potential growth. Well, if those drop, right, think teeter-totter, what maybe goes up? Well, today, again, as investors are maybe exiting some of those areas of technology, some areas, you're going to see that healthcare said, thank you very much. We'll take this opportunity to get a little push. So some investors saying, I'm going to exit, or they got stopped out of positions. Some investors moving to healthcare. Do not look at Abbott. It's gone straight up again today. If we look at staples, again, notice the timing. When we see, for example, the technology coming down through the floor, we're seeing the opposite of that in the lower beta areas. Now, if you look at that, I mean, it's not as big as technology to the downside, but the opposite here to the upside. But you're going to see that there's a clear correlation between people running from higher growth areas to more conservative areas. Okay. Now, the area that we talked about last week, communication. Now, this was not all great. Okay. Let's just be perfectly honest here. You're going to see that the tail went down pretty far here today. So that means that some of these stocks like Meta, like Google, like Netflix, etc., they also got pressed down. However, they've rebounded somewhat. Thank heavens. Okay. We'll talk about Meta here in just a sec. But if you look at, let's say, the financials, still holding there. Look at the credit cards, Visa, MasterCard, Travelers. Some of those stocks, maybe Discover as well, Capital One Financial, COF, pretty strong still. So it's not all, okay, damage, but you're going to see that this is why the paid money account tries to have, at a minimum, 3 to 5 sectors. The goal would be to get to 5 sectors. If the paid money portfolio, now let's shift now. This is where I want to be really transparent, okay? And I want to talk, now if you're not numbers people, give me, okay? But most millionaires are, so maybe you just get used to it. So here's the deal. When we take a look at, let's say, kind of effects like this, when we have gap downs, we should just kind of know that there's probably going to be stops. Now, the one thing I did not mention is when we had the gap down in the NASDAQ, we did see that the VIX initially spiked. Okay, not a real surprise, kind of an after effect or an effect tied to where the indexes were. Some people say, hey, I want to buy some protection. Okay, so maybe they're joining this class as we talk about an example here. Now, what I want you to see first off is where did this account close on Friday? Okay, so it closed at 105,796. Today, it is down about, I'm just going to say it's down 4,500. Now, I don't know about you, but most everyone always talks about, I'm up 20% this year. I'm up 15%. I'm up 12%, whatever. I am more interested in knowing what the drawdowns were, okay? Because that is, the upside doesn't tell you on a drop pretty severe. Which stocks kind of led the decline? Well, number one was NVIDIA, 30 shares of the stock. let me show full disclosure. Okay. When people don't show full disclosure, I get really, really nervous. Okay. I trust people, but I just verify. Sorry, grew up in upstate New York. Okay, now here it is. So the stock was purchased right here at 144, and it stopped out this morning at 123. So what's the point I want to make with this real quick, okay? So if we had $105,000 in that account, we're trying to risk no more than 0.5%. 0.5% of 105,000 is $525. Well, the loss was worse than that. It was 607. So the loss should stay below 525, but since it gapped down, I'll show you the chart in just a sec. The loss was 607. Okay. Now let's go to the chart. Now stop outs are not bad as long as they just go down further after it stops out. Okay. And that, you know what I mean by that? So what you're now going to notice is it was stopped out at the price of 123.81, pretty much at the open, slid down more than that. And again, we don't mind if it stops out, but it just needs to keep going down. So then we feel better about what happened, okay, to a point. So the loss was about what you would expect. Now, why does this one seem worse? It seems worse because it comes out of nowhere, but it's pretty much just a position that loses the max loss. Now, the max loss is a little bit more. It was about $84 more than expected. So whether it loses in 30 days or it loses overnight, not much of a difference. Now, so that's kind of a partial bad one, but nevertheless happened overnight. Now, the other one that was Cisco that was also entwined in this was stock of Cisco. Again, let's kind of show the transparency, okay? Show where the entry was, show where the exit was, and just kind of be systematic. So our job, first off, is to make sure that we protect the capital. We're not trying to be right, okay? Sometimes you think you're right and you're wrong, okay? We want to protect the capital. So on the 16th, got into the stock, 60.14. The stock goes up, the stock gets stomped out here today. How many shares of stock? 100. Was it over position size? Now, this is a major point, okay? Had the investor not properly position sized, the losses would probably be even more severe. This position was about $6,000. $6,000 on a portfolio about $105,000. The percent of capital of the account was 5.7%. Now, didn't really lose that much. Matter of fact, this one just gave back the unrealized gains and then lost about $40. So this one kind of hurts in the fact that I was doing good until. So what you're going to see is we got in about right there. It rallies up a couple bucks. We feel pretty good. And then just overnight just drops. Okay. Now, again, the biggest thing that hurts is not the $40 loss. It's just that it was just how quick it was. But nevertheless, and this is one position of probably, let's say 250 positions we'll do over the year. This is just one outcome. Not getting emotional about one position out of maybe 250 that we might do over the year. It's one outcome. One outcome. Now, NVIDIA, it's a max loss. A little bit more than a max loss. It's one outcome. Now, the other one that was more severe that we need to make mention of was GEV. Now, GEV, what you're going to see is also got intertwined, and it had a large gap down. Now, this is about as severe as you can get. I mean, if you get a stock overnight that goes down 20, 25%, it's a couple $100 stock, okay? We're talking about a 20% decline overnight. This is about as bad as it can get, okay? Could it get worse? Sure. But I'm just saying, when you talk about bad, a stock goes down 20% overnight, no, that would be a tail event, okay? Now, if we go back and kind of say, how bad was this? And I'm just going to make this quick. But guys and gals, we need to see full disclosure, okay? You can't just smooth this over and act like don't talk about these. We need to talk about them. Now, GV was purchased at 382. And notice we had a stop. I'll tell you what, we didn't have a stop at 326. So what's the risk with actually like setting a stop? problem is with setting a stop is when we look at setting a stop, if we had set a stop, example given, maybe like 390 or so, the stop is a order to trigger it to sell. And if it opens up lower than where that stop is, it could fill at a lower price level. Example, GEV. Now, this is where you just have to kind of consider, is this something you want to do? Now, some investors that I know, they don't use stops. They use puts as a way to have a right to sell. Now, that might stun some people. Some people, you know, and I know, they don't even set stops. They manually exit. So it's kind of up to you how you want to try to do risk management, okay? Now, GV was actually purchased at 382, and it stopped out at 326. And what you're now going to notice is when we go back to that position lost about $55 a share, 15 shares, okay? And so that means the loss was $828, which was $300 more than what it should have been. But we just had an event where it had a big, massive gap down. Now, when we take a look at that and say, wow, this is one of the worst ones we've seen in a while, $828 on a portfolio of $105,000, how bad was it? Answer, if we round up to the nearest 0.1%, it was about 0.8%. So if we said of NVIDIA, Cisco, and GEV, which one really hit harder? No doubt GEV. GEV lost us 78 basis points, or round up 0.8%. So if we look back and say the worst loss we had was GEV at 0.0078%, it's not a huge loss. Would have been a lot bigger if we didn't position size. But again, I think this is a position. It's one thing if it gaps down and sells off, but if you just get these big, massive gap downs, as we talked about with stops, it can be more severe. Now, let's kind of now, so first off, do you appreciate that we go over this? I feel like sometimes when I've learned from people, they kind of don't talk about the losers, okay? There is no indicator that's going to tell you about news that's going to come out overnight, okay? But sometimes, and by the way, this is pretty rare of the size or the effect with the news. This is not the common occurrence, okay? Now, are there any questions from that? Okay. Yeah. So here's the thing. GEV had nothing to do with semiconductor. You're right, but it still dropped. And the reason why I'm bringing it up is because when you take a look at the position, that was a position was stomped out, full disclosure. Now, when you go to the margin account, again, full disclosure, you take a look and kind of say, well, from Friday, okay, 29,702 to 29,450, it's down like $250. So it's down like 1%. So which portfolio kind of had more of a tilt towards technology? We could see in the balances which one had it. It was the IRA that was more hee-haw, okay, loaded down, if you will, to the technology space. Good reminder, if you're going to be really heavily weighted to one or two sectors, they better go up. But again, today, a pretty isolated event in the semiconductor space. Now, I want to speak to just real quick before we look at new positions, is I want to go to just real quick Meta for just a second. Now, what you're going to now notice on Meta is Meta didn't even fall. It did gap down lower. Some investor or investors, plural, we actually saw it fall down to the 20-period moving average, rally to the upside, was up to 663.87. Now, I want to speak to this for just a second, because last week what we did is we talked about the reward to risk methodology. Now, where is that position? Meta is, well, we got one position right there, okay? So we got, what do we got? A long call spread. And in this position in the IRA, we got, that's the position right there. There it is, Meta. Now, I want to kind of speak to this just momentarily, okay? And what I'm going to do is I'm just going to go ahead and just bring this up. And I want to just verify that you understand what we mean by reward to risk, okay? And we're just going to adjust the stop. So when I look at, let's say, that position on Meta, we can see where the target is, okay? So there's our bracket. Stop right there. And then we can see on the top, target right there. Now, do you notice anything? Well, so what I'm going to do is let me kind of just mark down where we are. I'm going to mark down where we were at the highest, because the investor or the trader would be doing this or considering this throughout the day. Okay. Now, I'm going to put the highest price, 663. What do we have? 87. Okay. What was the target? Well, the target was if it could go up to about, what's the price there? Price was about 673, 675. 675 was the target. Now, what was that reward remaining? Okay. Well, if we take a look at this and kind of say, well, if we were at 660, 387, and we're trying to go to 675, the reward remaining to the target of 675 was $11.13. Now, here's what happens. So now the investor says, well, James, I'm going to go ahead and put my stop right at that 5-day low, which is the blue line. So now the investor starts thinking about it. And if you went to the Common Sense University, which most people do, you're like, wait, why am I trying to make $10 more or $11 more? But my risk is almost, well, it's like from 663 all the way down to 609. You're willing to give $53 back to make $10? Does that make any sense to you? Try to make $1 to the upside, $5 down. $10 up, $50 down, 1 to 5, right? Well, if you take a look at that, the investor might say, I'm not going to do that. That's insane. Well, if we look at that from where the highest price was about an hour ago, 663.87, less the what's remaining. That stop would be at 652.74. Now, that's what we call the tightest stop, the 1-to-1 reward risk ratio, okay? The concern becomes when the reward to risk is 1 to 4, okay, 1 to 5, or worse, okay, or worse, anything like that, 1 to 4, 1 to 5, 1 to 6, 1 to 7, whatever, or worse. The investor, whether it's a stock position, maybe an option position, they might say, look, I want to maybe consider tightening the stops, okay? If they just set the stop below support, etc., the stops are probably going to be too low relative to the reward remaining. Now, last thing, if we said, hey, James, I don't want it that tight, fine. We're going to take that number by 1.5, and it's going to give us 1669. So what that really means is we're willing to kind of set the stop a little looser, okay? Well, if the highest, listen to me on this, if the highest price, yeah, but I'm not at the highest price right now. Okay, 663.87 less. That reward times 1.5, the stop would be at 647.17. Now, wonder if I said, you know what, I had to take Jax to the vet today, which I didn't, but let's say I did, and I wasn't there to see it, okay? And now I'm saying, geez, if I saw that price and I was trying to go to the 675, $11 remaining, okay? Well, the stop would be at 652.74. Well, where are we now? Well, let's take a look. Well, if I take a look at this and say, okay, where are we now? 652. I'm pretty much right at it. Okay. 651.88. So what I'm going to do is I'm going to move up my stop to 652.74. Wait, James, if you did this, what does that mean? What that actually means is it would stop us out of this position. Now, the question kind of comes is, well, wonder if you weren't there to see it, would the investor or could the investor just move up the stop irregardless and maybe just manually be exiting? The answer could be yes. Okay. What we're going to do is go stop GTC, put it right there, confirm send. Now, watch the price. We're $1 below that. So what's going to happen? Well, if we go ahead and say confirm and send it and say sell Meta if the stock gets at or below that price, which it is, what's going to happen is it should just trigger it out to sell. If that sells Meta, the target is canceled, and there goes Meta. The reason why I bring up Meta is that's the one that got very, very close to the target. Okay. And if you kind of looked and said, hey, here's where we were at the highest and the number of times, here's where the target was. Reward remaining was $11.13. Whether it's a stock or an option position, we realized that, hey, if we kind of looked and saw where a stock investor would set a stop, that reward to risk ratio was probably 1 to 4, okay, 1 to 5 or 1 to 6, et cetera, et cetera. If you get a reward risk ratio like that, the investor might say, I'm adapting, I'm adjusting to using a 1 to 1. If I'm trying to make $11, I'm not going to try to give more than $11 back. Or if I'm trying to make $11, I'm not going to give more than $16.69 back. Where's the $16.69 come from? It's just 1.5 times $11.13. You're just giving a little bit more room. So we have two options. 1, 2. We're choking the stop to there, which we did. It triggered out. And if we want to try to give it a little bit more room to see if it can go to the target, okay, 647.17. This is not new. Just reminding us of another example of it. Now, any questions there? Now, the comment says, how about a floating stop? Well, look, you can get positions that go up, right? Maybe rapidly, and you might try to adjust those positions throughout the day, etc. When you say floating stop, I'm kind of thinking that maybe you might be adjusting the position if it's going up quite aggressively. Remember the kind of the principle, though, we're never moving the stop down, okay? We're only talking about moving the stop up. When I think so Harry, when you say floating, I'm actually thinking that you're maybe adjusting that stop more frequently, maybe based upon the reward to risk that's getting kind of, well, reward shrinking and the risk is becoming bigger and bigger. And so you're tightening those stops more aggressively. Now, what I want to do here is I want to kind of take a look at some positions. Now, there was a question that was in the chat, and the question was in the chat about, number one, rolling a position. Well, so first off, what I would say is if you're ever going to like roll a call, roll a put, typically you're trying to roll when the delta gets greater than 70. If the delta gets greater than 70, then, and if you don't roll, if you were thinking about it, that roll then becomes more and more expensive. So for some investors, that cutoff point is if the delta gets above 70, they might roll. In our examples, we don't talk about rolling losses, okay? We talk about rolling gains, okay? So that's my answer in rolling. If you're going to consider rolling, you might say, I'm going to consider rolling if the delta is getting more than 70. Now, the other question that we actually had was kind of a stock position with protection and an option position with protection. Now, let's kind of go over this, okay? So let's kind of start with just real quick a stock position. So SBUX, okay? Now, one of the stocks that we have in the portfolio is Starbucks, okay? Now, if you go to the monitor tab, just so we can see this position. Now, by the way, what I need you to understand is, as a teacher, I want to show you good ones and bad ones. How do you the really thing is, I would say that today was really more of like people would call a black swan event. And guys and gals, it happens. The reason why they call it black swan is it doesn't happen every day or every week or every month. It's just out of nowhere, okay? Now, when you have these out of nowheres, you just have to understand that these three positions that we actually talked about, there are three positions of 200, 250 trades that we might do over the year. It's not the end of the portfolio. Now, it kind of hurt our feelings a little bit because it's how quickly it dropped. But really, outside that, we live to trade another day. Thank heavens for position sizing, okay? Now, the one thing I want to kind of go over just real quick is I want to look at just real quick the Starbucks position. We're sitting on a position that has 60 shares of stock. Okay, noted. And it actually is sitting right here, a couple bucks to the good. And this one, now remember, could we also go back to this and say, James, could we raise the stop as well? Just really quick on this. Does that stop look right to you? If you look at the target, we have about what, $4 to go? And then if we look at where this is, about $100-ish, And where the stop is, it's got $12 down. $2 up, $12 down. Does that look right to you? No. So this is probably the example where the investor might say, James, I'm going to do reward risk stop adjustments as well. And just to prove how fast we can do it, but I'm going to establish a new position on it. What's the highest price intraday? Okay, 30 seconds or less. Highest price intraday was $100.33. Okay, we want the highest intraday price. Target, please. Answer. 102 flat. So if we say, what's the target? So what's the reward remaining? $1.67. All right. Now, $1.67, if we said, look, I want to do it like a tight stop loss, well, 1-to-1 would just be the highest intraday price less the $1.67. Where's the $1.67 coming from? From there to there. Okay. I'm going to tell you, if you don't consider this, just be prepared to give a lot of profits, unrealized profits back. Okay. Who created this? I did, because some investors get sick of giving unrealized profits back. Now, if you take a look at this, what you're now going to notice, if we said a little looser, 97.82. We're going to use a tighter stop, 98.66. Move it up. And what you're now going to see is on this position, 98.67. We'll move it. Okay, 98.66. Fine. Confirm, send. Now remember, if it gets to that price or less, sell the stock. Risk, what we saw here today, if it gaps down like GEV did, it could. You could think in your mind that you have a gain in hand. You don't have anything until you confirm where it sells at. Now, some people, they just don't like that. Noted. Let's talk about this. Now, let's say the investor said, James, I want to buy the shares. Okay, fine. We're going to buy the shares of the stock. Buy. We're going to click on the buy. Okay. And what we're now going to do is we're going to buy the shares of the stock. Now, we got earnings upcoming. Okay, got earnings. It's coming up tomorrow. Okay. Now, what we're going to do in this example is if someone buys the shares of the stock, 100 shares, what's their delta? Well, their delta would be 100. Okay. Now, that's awesome if the stock goes up. It's not awesome if the stock goes down. Now, why might someone consider doing the strategy that we're talking about? Well, they might want to do this because maybe they're thinking, hey, wonder if the stock gaps to the upside. If it gaps to the downside, it might not be bad. Follow me where I'm going. Now, what I'm going to do is I'm going to go to the trade tab. And what I'm going to do here is I'm going to buy 100 shares of Starbucks. Now, noted it's a bigger position, but I want you to practice this in paper money account. Okay, 100 shares of stock. Step 2, we're going to go to an option. We're going to sell a call. Now, wait. So when we sell a call, we're going to try to sell a call that has maybe 20 to 40 days to expiration. Why? Well, if we sell some 24 days to expiration, there's time. And if there's time, there's probably a bigger premium. Okay. Now, what you're now going to notice is if we sell which strike, we tend to sell the strikes that have a delta of 30 to 40. Just stating the probability of the stock being above the strike by a penny, above the strike by a penny, at expiration. Well, if I pick the first one that's at that, it's really the 103. And so step 1, I'm going to do a single order first trigger as SEQ, is we're going to come and just click on the bid. Now, very important. You want to make sure that this says first trigger as SEQ. So if I write this order and said, how would I start this from the beginning? Click on the ask price of the stock. Not that bad. Step 2, 20 to 40 days to expiration. Going to typically look at the monthly options. Go down to the strike that has a delta of 30 to 40, going to sell the 103. There it is. So this position, what is this position? What do we got? Well, shares of the stock, okay, stock position, and we have an obligation. For the obligation, we're saying we want to get paid. Okay, well, they give an upfront premium. Now, we haven't made that premium yet. We're going to collect it, but we haven't made it yet. What we're going to do is we're saying, well, James, wonder if the stock goes down. Noted. Well, if that stock actually goes down, we're going to go look at the delta of, let's say, 30 to 40, and we're going to pick something where we buy a put. Now, how many of you are getting more comfortable with this idea of buying puts? How many of you are starting to realize a pretty big difference between setting a stop and buying a put? Well, remember, what does a put give the investor the right to do? What does it give us the right to do? Well, it gives us the right to sell those shares, okay, at where? At the strike price from now until expiration. So we kind of like to use our little whiteboard here, okay? So if we buy those shares at, let's say, 99.61, we have a short call sitting here at about 103, okay? 103. And we're going to ask ourselves, is there like a premium? Are we getting a credit or is there a debit? Well, if you got to pay, if you get 254 and you pay 259, there's a debit there. And it's a whopping 5 cents. So now what you're going to notice is from there to there is 339. That's the stock appreciation. Okay, not too bad. Let's subtract 5 cents off that because it's a debit. Okay, so the most we can make to the upside is $3.34. Now, if we take a look at this, if we look at the downside, what's the long put strike? 96. So what you're now going to notice is a lot of times people say, well, geez, I'm very uncomfortable being on over earnings with the stock position. It makes sense because you don't have any downside protection, maybe outside the stop. And as we saw here today, it's just a glaring obvious. Stops might not protect you as much as you think they do. Okay? It's a trigger to sell order. Just don't know where it's going to sell at. And now what you're going to see is when we buy that long put, we have a right to sell it at 96. So we have a max gain of 334. We have a max loss of actually, in this case, 366. Okay, from there to there, that's the stock loss. And then if we add another 5 cents because it's a debit, well, you're going to see that we have 366. So if we said what type of strategy, and I want to know if you can get this, how many of you would, like, what strategy really has like a 1-to-1 like this? What strategy does it remind you of? You better say like a long call vertical. Okay. Now, this and this, so for some of you that said, James, I'm mainly a stock investor. But what you're saying is we're using the short call for the credit, tap the upside, correct? And then if it were to go down and close below the 96, the short call would expire worthless or should. The stock could or should be sold, okay? Anything that's in the money could be exercised at expiration, okay? The investor has the right to sell at 96. What if the stock went down to 66, 76? The investor still has a right to sell it at 96. Not theoretically, not a maybe, depends, okay? Some people don't like those words. And that's why some people like pets over setting stops. Now, I'm not saying stops are horrible for everyone. I'm just saying you need to understand the differences, okay? Now, if what I'm going to do in this case is we're buying those shares, selling the call, buying the put. This is really what we call a caller position. And you're doing the whole thing at once, okay? Now, if we took a look at this position, if I go confirm and send, now clearly what do we want the position to do? And let me show you what this looks like on the risk profile. I don't like to say the word risk profile because some of you think, well, if I looked at the risk profile, that's only for like nerds. No, it's not for nerds. It's people that want to understand the strategy of what they're trying to do. So if you look at this position, you're going to see that there's a max loss. Check. We talked about that. And there's a maximum gain. That diagram looks very long call vertical-ish like. And what you're going to see is the delta for the 100 shares of stock and the options is 26. Now, the other option Greeks, not really a factor here. The biggest option Greek that we're sensitive to is delta, okay? Now, if the stock were to go up 10% or down 10%, the delta, okay, up 10% or down 10% doesn't significantly change. That good or bad? No, it's good, okay? So it's kind of holding pretty steady. So what we're going to do in this case, confirm and send. Read that order out loud in the IRA account, send this order. Now, James, we might, noted here, I'm doing an example with a bigger capital size, and we're looking to see, could Starbucks gap to the upside here? Okay. Now, if you're a stock investor and you say, well, James, wonder if I have a position already of at least 100 shares, could I just sell the call and buy the put? Yeah. Okay. Now, I'm going to tell you something right now. There's a lot of people that always talk about how much here's how much I made to the upside. Here's how much I made to the upside. In the world of investing, protecting your capital, okay, is the number one most important thing. You protect the king. Once you understand how to limit losses, as we talked about here today, it's not to say that the losses were completely enjoyable, but the thing is, when you have black swan type of events, do you have capital left? The only one of those positions that were really outside kind of that expected norm was GEV. And even then, it wasn't like horrible. It wasn't even 0.8%. I'm telling you, there's reasons why we kind of talk about these position sizing or capital size of each position, setting stops, risk management, and so on. It's important, especially on these type of events. Now, what I also want to do is I want to kind of show it. Someone asked another question, and that standpoint was really going, I'm going to do it through Let me just real quick. Okay. Now, the example that I'm going to pull here is, and I'm going to do this one kind of from the comment came in on a long synthetic. Okay. Now, what I'm going to do is, I know that this is a little wider than maybe we would like by about 20 cents. What I'm going to do on this is, if you buy a call, okay, buy a call. As a matter of fact, I'm going to do this in the margin account, so we don't have any position. We're going to right click on the 180, the call. And what we're going to do is we're going to buy the call and sell the put. Now, wait, what's that position call if we do this? If you buy the call and sell the put, there is your long synthetic. Now, if we put that on the risk profile, it's going to give you just a diagonal line. It's going to look very stock-like. Difference here is expiration. We don't have a dividend, and we also have an expiration. Okay, so there's some differences there. Now, what I'm going to do is confirm and send that. Now, could you do a long synthetic, long call and short put? Could you do that, and could you sell a call above? Could you buy a put below and make it caller-like as well without owning the shares of stock? Yeah, you could. Now, so that position fills. What I'm going to do here is we're just going to go to the same structure, right? We're going to sell the call with a delta of 30 to 40. That one would be the 192. And we're going to buy the put below with a delta of, let's say, delta 30 to 40. Now, if that position fills, all we're going to do is right-click on this. Now, this will be the same as if you own the shares of stock, or if you said, James, I have a long synthetic, and I want to have protection. Well, if I sell and go caller synthetic, last trade example, and I'm closing, I'm just going to go to the 172.5, which we already talked about. But we need that position to fill first here. But if I did that, this is going to be the same type of delta that we saw with buying the shares of the stock. Okay. Now, this is why we've kind of been talking about these callers. If the market is a little bit more volatile, kind of, having some downside protection set in place, kind of an important thing. Some people like to do that through the use of buying puts or caller type strategies. Okay. Now, I try to answer those questions as we went. I'm out of my time here today, but I'll make sure that that position fills, and then we'll have a synthetic action. And then we'll look at the differences between like a Starbucks, a stock example with caller, and we'll look at it from the option perspective and kind of see a side-by-side example. So great question there. I'm out of my time. Cameron May will be coming up at the top of the hour. Want to thank Michael Fairborn for answering his questions in chat. We spent some time kind of more exclusively talking about some of the overnight news that we actually had, the effects on the portfolio, and wanted you to really get a sense of kind of like what happens during that type of a situation and why might an investor maybe consider buying puts instead of setting stops. to show, compare, and contrast. Remember, with what we discussed, it was done for example, illustrative purposes only. And this has been the class on trading with technical indicators. Thank you so much. Stay tuned for Cameron May coming up next. Bye-bye.